Good morning, everybody, and welcome back to Schwab Coaching for the Tuesday edition of Trader Talk in today's market. I am your host, Kevin Horner. As stated in chat, it is chilly here in Denver. I'm pleased to be joined, though, by my friend Barbara Armstrong here in the chat. So please say hi to Barb, and she'll be able to, of course, get to some of the questions for us that I might be unable to get to today, though I intend to keep an eye on the chat for you all as we work through our discussion. We're going to look at a boatload of charts today, as usual. I want to make sure to hit up some of the sector action. There's been some fairly intriguing price movements here in the last week plus, giving us some interesting bottoms, potential short-term bottoms, maybe some opportunities on the long side in the short term. But nonetheless, we're going to look at as many of those as we can with you all today. And I want to make sure to also address an open example trade that I put on with you all last Tuesday and the last time I hosted this particular solo session. So pleased to get to it with all of you. If you're not already doing so, everybody, take a moment and follow us on X. I am at Kevin Horner CS, and you can follow Barb there as well at Barb Armstrong CS. Great way to get with us outside of the shows that we offer you. An opportunity to ask questions there in X as well. We try to post for you throughout the week. I'm a big fan of posting individual charts, things that pop up and look intriguing or may offer some insights to what the market is up to. That's the kind of stuff that I like to post there. So if you're not already doing so, please give us a follow there on X. Now, let's get into some disclosures so that we can get to the fun stuff for you all today. I'll remind you, of course, that our discussion here is always for your information and your education exclusively. Simply put, we do not make any recommendations here, so expressions of opinion are always subject to change without notice. Additionally, we talk technical analysis here almost, on a pretty high level. Really, what we try to do is utilize the charts to help us understand what's going on in the market, where money is moving around, of course. But remember, as we often say here, charting, trading, etc. This is all part of a puzzle, right? We try to put together as many pieces as possible to see the picture more clearly. The more pieces we have, the better that picture becomes. And of course, with technical analysis, what we want to remind you to think about is just not to base decisions exclusively off technicals. We think it's just a piece of the overall puzzle. All right, if this is one of your first times joining us, this is the process that we undertake here in Trader Talk. We do a top-down methodology approach. What we mean by that, we try to look at the broad market to begin, get a clearer understanding of how large caps and small caps might be acting. We may incorporate look at rates as well, kind of an important aspect as it relates to the underlying market, of course. And then we break things out into sectors, try to get an understanding of how we are applying funds to those individual sectors and what that could be telling us about the next opportunity we have for price action. So with that in mind, we're going to jump directly to the S&P 500. Now, the S&P had been undergoing a bit of a drawdown. As you can see, everybody, we are below a couple of key major moving averages that many of you are familiar with. We are talking about the 20-day moving average in orange, talking about the purple 50-day moving average as well. What's notable for some traders right now is we're seeing a bit of a shift towards short-term negativity here. Notice the 20-day in orange downward sloping through the 50 days. So we have a short to intermediate term potential breakdown occurring here. Now, a shift in a 20-day versus a 50-day, seeing the 20-day slope downward through the 50, it doesn't feel great. Ultimately, what it means is that the price action of the last month is not as good as the price action of the last 10 weeks approximately. That said, notice how in the past we have done this move before, everybody. We had this window right here where we broke the 50-day with the 20, and of course, it had a lot to do with this pretty significantly weak open back on August 5 here, everyone. But once we put a foot in the sand, so to speak, we were able to re-engage the trend. So now the question becomes, can we do just the exact same thing? Can we get back into trend nice and quickly? And some would tell you that, today's PPI may have helped us out a little bit. Expectations for the PPI came in a little bit tame, 3.5%. The expectation came in at 3.3. So there's a little bit of enthusiasm and maybe a little carry through from yesterday. But I encourage you to think about the overall trend that we have been witnessing. Yes, we had a weak open yesterday that got bought up, and that tells us that even though we made a short-term low, we still have bulls willing to buy dips, and that's a positive in the short term. Now, the key here becomes, having just made in the interim here, yesterday's open gave us a new short-term low. So the question now might very well be, if we get a rally, is it merely a rally into the downtrend line in red? Could it be a rally into the 20-day moving average in orange? The confluence of the two, the 20 and the 50, potentially. And the true challenge here becomes, even a rally from where we are, we're at 58.65. If we rallied from right here all the way into that trend line, let me change that to one of these moves so that I could actually mathematically calculate this. This would be a 2% pop into that red trend line, right? Even a move as wonderful as that, 2% to the upside here would be fantastic. Obviously, we'd be looking about 115 to 120 points into that red down-sloping trend line. But if that occurred and did not break out, then we would once again have a lower high after, mind you, a lower low. So what are we learning? We're learning that we are in the midst of a short-term downtrend. Nothing more just yet, but it is notable that we have had two tests that gave us lower high, lower high, lower low, lower low. So by definition, we have a short-term downtrend, and that lets us know that in order for us to be thinking about more upside, of course, we have to get outside of that range. We have to make a higher high in the short run. And that does not occur until we take out the highs we created here at about 6,000, 6,010. Okay, so that's what trend traders in the interim, in the short run here, are going to likely be monitoring as it relates to the S&P 500. So yeah, great point, Chris. I agree. It does give the resemblance of a falling wedge. The falling wedge has the feel of a bullish continuation pattern. And of course, when we start talking about continuation patterns, the one thing we need to validate a continuation is the breakout, right? So yeah, we might have that opportunity. The question now becomes, how are we going to handle this? It seems like we might get a little bit of optimism on today's PPI heading towards tomorrow's CPI. That could give a little bit additional clarity, of course. But what we want to guard against is the belief that it's an all clear signal from here, right? We don't want to go forward with the belief that it's all clear. We want to go forward with the potential that it's all clear, but let's be ready to act if things don't go the way we hope they would, right? Now, some of you would say, yeah, Kev, I don't believe in it being all clear, regardless of what PPI or CPI or any of the other data suggests. So I will simply trade the potential for a short-term rally into resistance, and those traders would be fine to do just that as well. But as always, know your time frame and then know your levels, right? So if you're short-term thinking that this is merely a bounce that is due to oversold conditions, well, then you might not be looking for the rally all the way into the trend line. It might just be that lower high at the confluence here of the 20 and the 50. That could certainly be a band of potential resistance or maybe just a pause along the way. So as usual, we really don't know what's coming. But as always, what I want to remind you to think about is, where do you fall on the trade spectrum, right? Are you that short-term trader or are you that long-term trader who needs more evidence? Longer term, not much has changed, everybody. I mean, we are about, everything remains in play. This is on the weekly chart. Look at where we reside. Okay, we're below the 20-week in white here, or light blue, I guess it were, where we've had that 1 week, one single week outside of this, 1 week below the 20-week moving average. So maybe this is simply a test of that same 20-week. Obviously, we need more time to play out, but I think the point still holds, and that is very simply that the timing longer than a year suggests the uptrend remains in play, and your time frame will help you discern whether you should be worried about working against something like that 40-week moving average, consistent with something close to the 200-day, for example, or if you want to be looking at things a little bit more actively, in which case you might be doing it on a daily chart. But intriguing move here, nonetheless. Gap higher, good for the day. Last thing to check out on the S&P, let's just look at what we did on the intraday chart. And of course, you all who are here frequently know that we look at the pivot points. That's these levels over here, everybody, these red lines. These are my resistance levels, and the green ones are support. Here is the pivot, which again is just calculating yesterday's price action and giving us an equilibrium price around which we may expect today's action to trade. Well, the fact is we gapped R1. So now what many traders will tell you is that today's short-term low now becomes your pivot point for the day. So essentially allowing everything above 58.55 to lean into a bullish posturing for the remainder of the day. Breaks below that level could signal short-term weakness, but ultimately a gap at the open to R1 or through R1 certainly starts us off on the right foot today. So a good open for the S&P, being up about 0.5%. Let's see how we're looking in the NASDAQ. We'll shift back to our daily chart here and take a peek at the NDX. Also having a nice day, also giving the presentation of a potential falling wedge, which again is bullish by nature if it can break to the upside. Everything I said about the SPX may very well hold on the NDX here as well. We have a failed test at the downtrend line, another one right here, lower low, one other lower low, and then why not a third lower low? Now, again, that doesn't mean we can't be in the midst of breaking these lower lows, right? But in order to bust a downtrend in any window of time, we have to make a higher high. So we know that we could rally into the 50, could rally into the 20, ultimately could rally into the downtrend line, but we're not going to be looking at continuation opportunity until we get through somewhere in the neighborhood of about 21,700. I should put that as a line up there. Somewhere in this vicinity, okay? So that's what traders are probably eyeing on the NDX as well. Again, a gap level today does give traders some opportunity, right? And let's just think back quickly to management of our individual positions. If we were managing a NASDAQ 100 position or the NDX or SPX, as it turns out, both showing those nice gap moves at the open, many traders will just look to the low and say, hey, as long as today's low is maintained, well, then we may have the short-term bounce we're looking for. Again, maybe short-term, maybe continuation, too early to know one way or the other. But if you're looking for the opportunity to trade for that upside, the gap today might provide traders that comfort zone. When you start to move into that gap that was created today, if it happened today or tomorrow, for example, that's going to look more like a quick rejection than anything else. So that's what we're trying to wait on here. Do we actually hold the gap level, or do we start to fill that in? Obviously, filling it in to the downside would not be what we're looking for today. Quick peek on our 5-minute bars. They almost the exact same thing here with an open right at the R1. That's excellent. We love to see that in terms of opening and gapping higher, just like we said on the SPX. And so when I say that, I'm saying that traders on the long side, traders who are bullish and want to see the continuation of what's been a fantastic 2-year move with better than 20+% each year, they want to see continuation of that. This is at least a nice start after a pretty good open, or pretty low open, I should say, yesterday. And again, the sentiment shift a little bit with yesterday's lows. So a positive open from the bullish standpoint here on both the SPX and the NDX. Now, let's jump back to our daily and let's take a look at those small caps. So we talked a lot lately about the challenge the small caps have been under, right? We broke the uptrend line. That's this white one here. I'm going to go ahead and change that to red because unfortunately, once busted, that uptrend line now becomes a potential resistance zone, right? And many of you were here last week when we talked about this potential bear flag. Well, that bear flag did play out bearishly. So we look now and can say, yeah, that is in fact a bear flag because it broke to the downside and it actually caught the 200-day moving average with the low just yesterday. So that's a notable shift here, right? But ultimately, we have seen small caps continuing this trend for a bit here. I mean, you've got now we have potential for how we call these bounces, whether they're anything more than just a relief move remains to be seen. That does mean we have to either bounce off the 200 and then get back through, most likely, this zone around 2,300, everybody. Okay, that's absolutely an important zone for us. Now, any bounces that lead us to failure at the 20-day or the downtrend line or the extended former support, now potential resistance at 2,300, that's going to be kind of notable for us, isn't it? And it's going to definitely lead us into a little bit of concern. The rates have continued to climb, so we've noted that selling of treasuries has resulted in yields continuing to move higher, and that has continued to put pressure on these small caps. So let's quickly, actually, before we get to yields, I want to talk about a couple more things. First of all, if you're looking for some semblance of confirmation, we want to see not only the Russell back above the red ledge here at 2,300, but we want to see that we get the RSI over the 50 line as well. And some would say even over the 55 level. Ultimately, we want to get through what should be considered overbought conditions in the Russell via the RSI. So in strong downtrends, the RSI can often rally into a range between 45 and 55, and that's where it finds itself to be resistance or overbought conditions. Remember, the RSI is a banded indicator. It ranges between 0 and 100. It can't go outside of those. And in sideways price action, it's considered overbought conditions when that RSI climbs through the 70 level, or oversold conditions when the RSI falls through the 30 level. But commonly, in the midst of an uptrend, it can be considered to be oversold as it falls to the 45 to 55 range, or in the midst of a downtrend like we're under for the last 2 months here, it can be considered to be overbought when we get into that 45 to 55 range, okay? So you have to kind of shift your mentality a little bit in terms of how you think about the RSI. And if you're looking for confirmation, we want to see the group here, the Russell 2000, above 2,300 on a closing basis. And we want to see that the RSI is also over about 55. That would be potentially giving us a little bit of a heads up that maybe things are moving more favorably. So some traders like to think of the RSI in a similar manner to just standard technical analysis. Can I get support and resistance from the RSI? And the answer to that is yes, you absolutely can. So if we can get through some of these levels that we've noted as having been weak, right? The last bounce we got into resistance pushed the RSI only to the 45 level. So if we can get that through the 50 level and make a higher high while price also makes a higher high, then some traders would look at that as confirmatory in nature, okay? All right, now let's look at those rates and let's see. They are off a little bit, but as you can see, everyone, if we were simply looking at this as an equity chart, what would you all be saying about this? Would you be thinking, well, I'm dubious. I don't know if this uptrend can continue. I'm not sure that there's any other way, unfortunately, to look at this but bullishly, right? We've had a fantastic move off of the lows. This 36 ledge, essentially 3.6 on the 10-year yield, pushed all the way up to 4.5, and then we pulled back to the confluence of the 50 and the 200-day moving average right here. We made a little test and then continued higher. Got a bull flag here, flattened out, let the 20-day get caught up, broke to the upside more. Now we're hanging out at that 4.8. If this continues, it will continue to put on pressure for the overall market. We have to keep an eye on this. Now, it doesn't mean we can't have moves like we're getting today. Clearly, right? The 10-year is up. Today's price action, all tied essentially to the concept or the narrative that maybe inflation's slowing a little bit. Obviously, we need more data, but the market liked today's report no matter how we choose to look at it at this time, right? We're getting a lot of green on the screen today. So we're going to be pleased with that. We'll take that while we can. Now, there are, as always, I'm certainly seeing questions in the queue about the VIX. Let's hit up the VIX real fast and just see how we reside. We're back at 18 after having a very brief move all the way up to about 22. But that was very quick. That didn't last very long. So now the question, I guess, becomes, is 18, 2 weeks ago we were rallying when we were pushing into 18, that became our resistance spot. Well, now we're sitting back at 18, 18.6, and we need to make sure that we can tamp this down a little bit further. The question I have is whether that's feasible in advance of subsequent earnings coming here, right? So we are absolutely moving forward with earnings season coming here. So there's perhaps opportunities to see the VIX kind of holding a certain level as we continue to see investors and maybe those large pocket traders looking to protect some of the profits that they might be sitting on here. So got to keep an eye on that. Obviously, I think traders would love to see that VIX well below 15 again. That's going to give more confidence. So let's see how we act over the coming couple of days here. Again, I think tomorrow's CPI and earnings coming here will give us a little better picture as it relates to the VIX specifically. All right, so let's see what else we got going on here. Let's see. Yeah, I think a lot of traders, Carol, would agree with you. Like to see maintain that 10-year under 5%. We're getting to a questionable level as to whether it makes a whole lot of market sense to continue pushing higher if rates continue pushing higher as well. We'll see how that plays out. We also should look at how the dollar index is doing here. And then I want to get to a couple more of your questions. So the dollar continues to rise, continues to be a bit of a headwind for the market. So the combination of rising yields, rising dollar can absolutely keep us on our toes. Here's the thing that concerns some traders about the rising dollar. It's this ledge we broke through and have been bullish since. So breakout, test, breakout to new highs. But look at this on the weekly chart, everybody. And I think you'll see the concern that some of you may have. And that is the substantial range we've been trading within for a while. This goes back to October of 22. All the way through October, November of 24, we're looking at a 2-year consolidation pattern. That breakout may imply much more upside on the dollar. And again, headwinds, as the dollar continues to climb, headwinds on U.S. companies with multinational leans and action, right? So we got to keep an eye on the dollar as well. Okay, what else we got here? Beauty at its best. Great to meet you as well in San Diego. I'd love to hear from more of you that made it out. Certainly got a ton of great input, by the way, from the San Diego event. And for those of you who've not as of yet had that opportunity, check out schwab.com/events. Look for those in-person opportunities, everybody, where we're either doing one of our market drive events or the workshops. Remember, the workshops are your 2-day event where we ask you to come out with your device. You can come and watch the segments that we basically offer here on YouTube, but we do them in a bit more of a personalized manner in your local city, and try to give you 2 full days of ongoing education and work with coaches. So it's an excellent chance to get that. If you've not yet had the opportunity, I'd certainly invite it. Had a lot of fun with you all this past weekend out there in San Diego. Okay, let's peek in on a couple more spaces, everybody. What do we say with the semis? Let's look here. Okay, we had another test, didn't we, guys? Look at this. Let's back this out a little bit. So as I was worried, granted, worried, not believing, but we rallied back in to that exact same spot. See right there. Look at this. Another test here, another one here. Oval. Come on. There we go. Another there. So we've seen this play out. We're looking for something different, everybody. Are we getting it? We still don't have anything different. We have higher lows. We have matching highs. So the question now, can we push into the matching level again? Can we get up to 53.75 once more? Perhaps. Could we fail at this confluence? And let's look at that again. Look at how tight these moving averages are. These moving averages are basically right on top of one another. 20-day, 50-day, 200-day, all at the same level. Kind of lets us know 51, between 5,050 and 5,100 on the SOX looks to be fairly important here. Why do I say that? Well, mainly because when you look at it, there are three different time frame style traders watching that same range, right? It's about a 50 to 60, maybe 75 point range, and we're all keeping an eye on that exact same area. Can we get through it with any conviction, or do we manage to make lower highs from here? Do we make any lower lows? As of yet, we really haven't. I mean, yeah, we could say in the very short term, we made a lower low with the open yesterday. What we just don't want to see is today fade. We had a good open here on the SOX. It is fading a little bit. We're not going to overdo that thought process just yet. It's only the first 25 minutes of the day. But I think that bears watching nonetheless. The real concern would come with a move through the low we made just yesterday. Right now, if today's move holds, then many of you would say, well, we got today, if we hold this ledge at the close, we would be above yesterday's high, which would suggest that for short-term traders, perhaps we have a day where we close above the high of the low day, which could very well be indicative of a potential short-term move. And that might offer traders somewhere in the neighborhood of 300 upside points into potential resistance there at around that 53.60 zone, right? So we have something to monitor on the SOX, but this the chip conversation will potentially be tied to the government's view on how to handle chips going forward, and whether there's some additional steps by the government to maybe limit opportunities for not necessarily just the chip stocks, but specifically countries. And we got to keep a little bit of an eye on that as well. So there's going to be some headline risk there. Now, one area that we don't always get to, but I think was presenting an intriguing look, was the transports. Now, the transports have been under pressure, but boy, how about this for a consolidation, everybody? A really tight consolidation at what could be considered major support. Today's price action could be telling us a little bit of something. Now, we don't want to speculate as it relates to the broader market, but from a standpoint of how this is acted, many traders would look at today's moves as opportunity potentially to shift into transports, maybe up to resistance. We don't yet have clarity, of course, but if you look at where the 50-day moving average resides relative to prior highs and prior lows, maybe there's a band of resistance in this area right about here. And that's that little gap zone from the high. And if you wanted to extend it all the way down to the ultimate gap, which, when we gapped higher back in November on the election move, so that's what this gap was, you'll note that it's very important gap level for the S&P 500. That's basically what we just tested, right? So maybe this becomes a zone of resistance for the transports. That bears watching as well. But a good move today in the sense that we are back above the 20-day right here. So if that holds back above the 20, that's the first time we've been above it since we took it out back on December 3. So you're looking at about a 6-week window of a drawdown and a 2-week, about a 3-week consolidation at support. So that does give the appearance, if nothing else, of an improvement to what's happening in the transports. Okay, we've got some moves that I wanted to address in some of these sectors, everybody. Some significant detail, but I wanted to make sure that we also looked at, there's a question here about, let's check out the equal weight. So real briefly, I wanted to go back to the SPX. So the SPX, interesting. So turning around, we've kind of faded a little bit, 0.13. Let's see how that looks on the 5-minute. Okay, that's notable. Look what we found. We found the 20-period exponential moving average. Some traders would suggest as long as we hold that, we'd be all right. A slip through the 20-period on the short run here might mean a fall to the actual pivot point there at 58.15. That's going to be far less bullish than we were hoping. So let's see if this 20-period EMA maintains. But just real quick, notice how we were above it from about 10 o'clock yesterday morning. That would be noon Eastern. So after about the midpoint of the day, we got above that 20-period EMA and have held it since. So maybe there's an opportunity for short-term traders to work against this new low as a ditch out. If they believe that there's more bullishness coming today, then you could certainly consider setting risk maybe against these lows that we just created in the neighborhood of 58.40. Because if this low holds, then one might think that there's more continued upside based on what we've seen out of the 20-period EMA here going back into midday yesterday. So let's see if that maintains, but that does give us something to look at. The question I wanted to address was the equal weight. So we've seen the SPX, the cap-weighted version of it. That's the SPX, of course, but let's look at the SPXEW. And you'll notice here, we've certainly seen a bit more weakness, haven't we? I mean, we broke the uptrend line pretty well. We've been below it for now about 3 weeks solid. And we're trying to bottom out, but we still are below the 20-period simple moving average. And there does appear to be, some significant struggle here in this view, right? So this we need to get above the 20-day and even above the 20-day, everybody, because the equal weight has been working so well. It's unclear if moves through the 20 are going to be sufficient. Notice here, this is the 20-week moving average once more. I have to feel like that's where we've just failed. If I zoomed in again, let's just lift that line for you all. Make it a little easier. But look, this peak came at 72.23. This peak was 72.12. So look, I mean, if we just said we got to get above these, I mean, this would be higher highs, right? That's what we're looking for on equal weight. We aren't yet there. Okay, so could we be? Sure. But from this standpoint, trader that bought up the lows here along the 40-week moving average here in purple, it makes sense to maybe look to 72.25 as a potential zone for a little bit of profit taking, but at the exact same time, a move through there could give us the continuation opportunity that we're looking for. But clearly, we are not seeing quite the robust move that we would like to see, right? This SPX equal weight may be at support, but I'll tell you what, if we do not maintain that 40-week moving average, that would be a significant development. Notice the next level down below in terms of moving average, mind you, not horizontal support, but the moving average is that 100-week is well below us at around 64.50. That is quite a ways off, everybody. So chances are any weakness that the equal weight gets would find some horizontal support, but that doesn't mean it's anything more than just a potential for a bounce. This is approximately an area where I think some traders would look to. This was a prior peak that was failed at a couple of times, and then finally we got through it. So this might be that zone of horizontal potential support. We got to keep an eye on that one too. So there's your look at the SPXEW. Oh, and by the way, look at that RSI down below. So this is an appropriate level for a bounce. This could be considered oversold conditions as it relates to the RSI here, right? Remember, we talked about this just a little bit ago with the look on the daily chart. The RSI in 45 to 50, if that's in fact oversold, that can imply continuation of our uptrend. And really, nothing on this chart says that the uptrend in the longer run is broken, only in the shorter term, being that something like the 20-week moving average we're monitoring versus the 40-week here, right? Okay, hopefully that helps out everybody. All right. Couple of key sector moves. I wanted to look at industrials, which is off a bottom and had a bull engulfing candle at support yesterday. So some traders would look at that as true optimism, right? Had a great gap move today, and we could potentially be through former support now, potential resistance. Let's see how that plays out. Some traders could work against the intraday low on the industrials here instead of the intraday low today or the 20-day simple moving average. Either one of those, if you believe that we have maybe turned a corner in industrials, that could be the case. Thea, that was just looking at the longer term trend. So the reason I was looking at with the SPXEW, go back to it real briefly here. I was looking at that on the weekly chart, but only because we see that on the daily, we found the support at the 200-day moving average. And so I was simply looking to give us a little bit more clarity here. We found the 200, and look, that's a longer term support zone, right? So I just thought it was appropriate to give you all another view of alternate time frame as a reminder that we have to, even if you're a short-term trader working against 20-day moving averages, maybe even 10-day moving averages, sometimes by pulling yourself back and giving a larger view, looking at something on the weekly chart, maybe eliminating some of those candles will make the trend a little bit more clear and obvious. That's why we were looking at it on the weekly. Not to suggest that you have to look at it on the weekly, but as many of you know, if you're a short-term trader, you can't just look at things exclusively in the short term. It can sometimes be very helpful to pull back and take a larger overarching viewpoint and ensure that you're not finding other areas of potential support or resistance that could have a greater impact. Remember, the longer a trend has been in play, the stronger that trend is, and therefore more reliable. The shorter term you work with, the less reliable the trend analysis becomes. Yes, it's true that we can find many of these same concepts in weekly charts, daily charts, hourly charts, 5-minute bars, but the shorter your time frame, the less reliable those indications and detail become. Just become less reliable. So think about it from that standpoint. Hopefully that helps out as well. Okay, so we looked at industrials. Couple more that were potentially notable today. How about discretionary? Discretionary is still in the channel. Okay, we got the bounce at the 50-day, good candle, bouncing at the 50, RSI into that 45 zone and bouncing. That's all positive, and yet still in the channel. So if I drew this down a little further, there we are, still below it. Some traders are going to want to see us over the 20 first. That might be an indication. Some would want to see a new high, and that would be taking out the January 6 high at 1877. Okay, but I bring that up because it is tested support off of that gap level can give you something to consider. So discretionary looking okay, still in its down channel, but depending on how you choose to trade. Are you a buyer near support or are you a buyer on momentum and breakouts? Big difference there, right? Always know what your preference is. Hopefully that'll keep you on the right side of some trades. A couple others here that have been notable. Unfortunately, one of the big ones is healthcare has been rough, to say the least. Now, what I've drawn in here is a potential bear flag. Now, it's getting a little long in the tooth to remain flaggish. However, it still continues to note rejection along the way. So where is the ultimate potential for rejection? It might be that 50-day moving average. You got to call out the shift in trend, though, here, everybody. We have been working against the 20-day. There's been limited windows above it. Maybe if you incorporated that so-called Horner rule, you may have been left out of healthcare. Notice here we did have a full week above the 20-day moving average, and it still moved lower than that. So there's always the opportunity that what we're witnessing isn't actually a shift in trend just yet. But for the short run, it is notable that we are now 4, 5, 6 days above the 20-day. And so some traders might look at this and say, well, you know what, this is improving enough that I might be willing to start new position here. as long as the 20-day moving average remains as support. And some of you might get started with smaller position size. As you know, as a trader, one of the things that some traders incorporate is to, instead of buying full position, they lean into buying just portional positions to get started, right? If you're feeling a little bullish, as opposed to believing that there's immediately more upside, instead of 100% of the trade, maybe just 25% of the trade, and let's see what happens from there. So that's one way to look at potentially healthcare here, but ultimately, unfortunate, still a downtrend, right? I mean, we've been below the 50-day now since early October of last year. Okay, let's see. Communications gave us a pretty intriguing hammer candle there yesterday, but have not gotten continuation just yet, everybody. So this looks notable. If nothing else, support seems to be pretty well established there. So the 50-day below us, nice hammer candle, but as of yet, not following through. Want to see trades through yesterday's high to give you some validation on communications there. And then why not? Let's look at tech, up 2/3%. Significant move below the 50-day moving average, hoping we're getting a bounce in here. I'll point out the bounce level is on a gap zone. So if I came all the way back and drew, actually, I'm going to do that right here. Yeah, look at this, right to it. So here was the gap. This goes back to July when things broke down. So here we had former resistance becoming support. It was support, a resistance in here, and then it was support in here, and then it was support here just yesterday. So we're going to hope that that's the case on technical, on the technology space, everybody, but a little unclear. Be aware that, of course, the 50-day in purple could be resistance here. We've been above it since back to September, and then suddenly we're below it for 3 days. So is it possible that we could be looking at a bounce into the 50-day as resistance and maybe confirmation of the technology sector breakdown? That is a possibility. We want to get back up above the 50-day. We want to get above it and hold for a series of closes. So that's what we're looking for, at least as it relates to tech. And then the last thing we're going to do is just check on that trade I had in Carvana that we placed last week. It was a small trade, not a big one by any stretch, but we bought on a bounce move. So let's just take a peek and see how that trade's working out. We stepped in at market with the execution on entrance and then a bracket thereafter so that we could be sellers at resistance if it gets back to 260. We could be a seller beneath us at 175 approximately if it broke down. Thankfully, to this point, we haven't seen either one of those scenarios play out. And because we have the trade bracketed, we really don't need to make any shifts to anything we're doing here. We can simply allow our existing trade to go to one case or the other, right? Our best case or our worst case. Hopefully it is our best case and we get continuation and we get above that 20-day. And if we get above the 20-day, well, then we have a discussion on board where we can start talking about raising that stop order to start mitigating some of that downside risk a little further. All right. So that's all I have time for, unfortunately, for you all today, but I am very, very glad to be back with you all. So thanks for being here today. Thanks to my friend Barb in chat. And I see many of those familiar names here in the chat today as well. So just a reminder, follow us on X, Kevin Horner CS, Barb Armstrong CS. And if you like today's content here, please hit that thumbs up button for me. That'll help me out a lot as we get this particular show into the archives for you. So expect to see that available for you here in the coming few hours. But plan to be back with you more tomorrow, of course, for Trader Talk on Wednesday. So with that, we'll wrap it today. Have a fantastic Tuesday. Definitely keep it tuned right here to the Schwab YouTube coaching channel. As you know, much more coming from us here today. So thanks, everybody. I look forward to seeing you all again real soon.